What's up everyone, it's Karthik with MoneyVest. So wanted to do one more update for all of you. We've got the PPI numbers coming out later today, so I will be live for those numbers as well. And of course, CPI causing a lot of volatility here in the markets yesterday. The volume profile and the book depth continues to be very weak, and this is a very narrow and concentrated rally, as we did see a rotation back into a risk-on trade, which was of course Nvidia, for the most part accounting for over 41% of the entire move in the S&P 500. So this is from Bloomberg, and we have built something very similar on our MoneyVest platform, as you can see over here. So we essentially give you the market cap for the S&P 500 sitting at well over $51 trillion. The daily change as of yesterday was just over 1%, as that's how much the S&P 500 moved higher. That's over $551 billion. And if you scroll down, it'll essentially tell you the market cap change, and of course the market cap change on a daily basis. Nvidia pushing up well over 8%, accounting for over $215 billion. If you again do the math here, 215 divided by 551, we're accounting for just over 40% of the move in S&P 500 coming from Nvidia itself. Microsoft 12.8, Amazon a little bit over 9%, Broadcom also almost 9%, Apple up over 7%. There was a lot of volume that kind of picked up right around the 10:30, 11:30 a.m. Eastern time right when around Jensen Huang was speaking at the Goldman Sachs conference, and there was definitely an overburdening call premiums. Calls, of course, pushing higher relative to the put options, as we already know that my calls that I've sold are jumping, like absolutely going crazy on Nvidia that I had to trade for this particular week. So we got lots to cover in this video. Make sure that you drop a like, subscribe to the channel, and do me a favor and share this video with other traders, investors, other family and friends members that can benefit from this video as well. So first things first, I really want to go over this particular chart, which I think is very interesting. And what you'll notice is the volume profile, as well as, of course, the volatility peaks and S&P 500 lows during the 2 months of August, actually 3 months, August all the way through October. So that's really what they are looking for, both for the volatility peaking and S&P 500 forming a low. And what you'll notice is that 63% of the times we have seen the volatility peak during October. And this is during the election years. So this is essentially going back as far as 1928, and these are all election years: 1928, 1932, 36, 40, 44, so on and so forth, all the way down to 2020. And what this research essentially studied for is how many times the volatility essentially peaked, either in August, September, October, and when did the market essentially low. And it makes sense, right? It makes sense why election years volatility peaks in October, because election are literally in November, and that usually creates a lot of uncertainty. We do see volatility spiking right around that time. 63% of the times VIX spikes in the month of October. However, the market is very forward looking, and 46% of the times we've actually seen a market low in August. In September, 21%, and October has been 33%. So it's been a little bit more sort of all over the place, but volatility is really where I want you to focus on, where 63% of the times we are seeing volatility peak in the month of October. Now, this right here was the quick shifts in the market and VIX as soon as the CPI numbers came out. And what you'll notice is we did see a little bit of a negative reaction, a bit of a knee-jerk reaction from the markets as soon as CPI numbers came out. Core inflation a little bit higher than what the expectations were. Volatility here dropping back down very quickly. So we did see, very small spike in volatility, and of course started to rotate back lower as the market digested that report and pushed up. And right when the markets opened, we did see a volatility, once back up, going up to as much as 21, 22 as the markets continued to rotate back down. And this right here was the reversal right around that 10:50, 11 a.m. Eastern time frame. So again, somewhere between 10:30, 11:30 a.m. Eastern, we did see the market just absolutely rip higher and higher, with the, again, S&P pushing up over 1%, volatility getting crushed down. So that's that inverse correlation between those two. And a lot of that, of course, coming on the back of Nvidia. So if I essentially bring over Nvidia, you'll see a very similar chart, right? It's nothing crazy. It's like almost identical, because Nvidia was, again, accounting for over 40% of the move in the S&P. So that kind of formed the bottom right around that 10:50 a.m. Eastern. Jensen Huang was also talking right around that time during the Goldman Sachs conference, and volatility absolutely getting crushed all the way down as Nvidia got a lot of buyers, a lot of bidders stepping back up. So the volume yesterday was 441 million shares traded versus the average 30-day volume of 371 million. So definitely more, volume being traded on Nvidia. Lots of people, once again, very optimistic, and that risk on trade seems to be back on just for the time being. Now, this is a narrow depth in the markets. What I mean by that, this right here is a CME watch tool. Very useful. And this is the book depth that we're looking at going back as far as August of 2023, not 2024, but August of 2023. And you'll notice that the markets tend to really have a healthy uptrend, healthy rally, when there is a lot of depth, there's a lot of volume coming into this market. So, in blue, you've got the S&P 500 as it continues to move higher. You'll notice that the volume was also significantly broader, right? There was much significant breadth here in the markets as opposed to what we're seeing now, right? It's a very concentrated, very narrow market as we continue to see this reversal back up. You can see that we've pretty much been cut in half in terms of that depth in the market that we're really used to seeing, right? So this uptrend, I could argue it's very much concentrated, very narrow rally that we're seeing. S&P 500 still well within 2% of its all-time highs. So if you come over to our market snapshot over here, what you'll notice is the S&P 500 also, still well within a dip, less than 2% of their all-time highs here. So where is S&P 500? There we go. So a little bit over 2%. We've got NASDAQ here still in a pullback, down almost 7%. And there's a lot of individual stocks, right? So for example, you've got Alphabet, Nvidia, AMD, Broadcom, Oracle. A lot of them are still in a bear market and a correction. So every time these stocks actually tend to see a little bit of a momentum higher, as we did yesterday, markets tend to push up on the back of these companies, Magnificent Seven alone, because they accounted for over 80% of the momentum higher yesterday. So, we've also got some other indexes. So, for example, Big Three, the percentage weight in the S&P 500 is 18.5%, almost $10 trillion in market cap combined for these three companies, $321 billion. And what's also crazy is that if you take a look at Magnificent Seven over here, 30% of the weight and $432 billion. Right? So $432 billion for these 7 stocks here. So if you do the math, 432 divided by 551, we're looking for almost 80% of the gain in the S&P that came in from yesterday, came in from just these 7 stocks. Now, if you compare the top 10, this is also including for Eli Lilly and Broadcom and Berkshire Hathaway, so that's also being included, $516 billion increase in just the market caps of these 10 companies. So if you do the math now, 516 divided by 551, and we're now looking at over 93% of the change in the S&P 500 coming from just these top 10 companies, which really only account for less than 2 to 3% of the market cap for these companies, right? So concentration is very, very high at over 35%. And that's really what, that chart essentially represents, is that this has been a rally that is a little bit more concentrated. However, we do still have a lot of stocks that are trading above their both 200 and 50-day moving averages. So this right here is a chart that shows us the percentage of S&P 500 stocks trading above both their 200 and 50-day moving averages. This is above 200 but below the 50, and this is below 200 and below 50 as well. So there has been, again, a little bit more on the breadth side, pretty strong breadth from the entire market, because we do have over 53% of stocks trading above both their 200 and their 50 simple moving average. So still majority of stocks are trading above their moving averages. However, the recovery that we're seeing, the velocity or the momentum that we're seeing from this market is coming largely from Magnificent Seven, because in a market which over 30% is being controlled by the top 7, top 10 stocks, it is not that unusual for us to expect that if Magnificent Seven does not go up, the markets are going to fail to see that momentum, right? Despite how other sectors are doing. I mean, for example, year to date, we do still have utilities, staples, right? Industrials, materials, healthcare, all these sectors continue to move higher on a year-to-date basis. So if you come over to performance on a year-to-date basis, you still do have utilities. You got financials, you've got communication services, staples, technology, all these sectors still up. But it's not enough. It's not enough because of the fact that it accounts for such a small percentage of the overall market cap weighting. Now, this right here is also the bull markets in the S&P 500 since 1957. So going back as far as 1957, how long the bull markets have lasted for, and the median or the average at least has lasted for anywhere from 38 to as much as 52 months for the S&P 500. These are some of the indicators of whether there's been followed by a recession or not. I do believe that there is a possibility, or at least some probability, for us to see a mild to maybe even a semi-severe recession in the US in the next 3 to as many as 6 months, because of the lot of indicators that are starting to suggest some weakness in the economy as well as CPI that is now pointing a little bit more towards stagflation. Because if you compare these numbers to what we are seeing from 1970s coming over to this chart, you'll notice the 1970s we're kind of following a very similar trend where inflation has been rotating back down, so that's good. But now we're coming to a point where the Federal Reserve is going to start cutting interest rates. So as interest rates come down, then the big question becomes, is inflation going to reaccelerate back higher, or is it going to take that trajectory of, okay, going sideways a little bit and of course coming down slowly and steadily below that 2% level? So that's going to be the big question for the market, and of course whether that's going to be followed by a recession or not. I do think, again, I could be wrong, and I hope I'm wrong because nobody wants to see a recession, but I do believe that there is a probability for a mild to a semi-severe recession, not expecting for something crazy. But if inflation continues to stagnate sideways a little bit, interest rates come down, there's always that possibility that it accelerates back higher as it did back in the 1970s, because we had to raise interest rates 3 times just to rein in inflation and bring it back down and just to kill it under 2%. But that wasn't possible until interest rates were hitting double digits, right? So that was actually quite a crazy event in the great inflations of 1970s. So the questions, again, the couple questions the markets are still a little bit more uncertain on is, with the Federal Reserve rate cut that we already know is priced in and is coming, right? In the next week here, we're going to see the first rate cut from the Federal Reserve in over 3 years since the pandemic, basically. The question then becomes, number one, is inflation going to accelerate back up? That's the number one question. Number two, is recession going to follow with this inflation acceleration? Or even if inflation starts to stagnate sideways, what's going to be the trajectory for the economy moving forward, considering that there are some signs of weakness in the overall economy as well? So that right there, again, are some of the things that I really wanted to discuss in this video. Take it with a grain of salt because the market right now seems to be very much focused on a risk on trade back up, with Nvidia kind of leading this charge up another 1% back over to $118 right now. It's possible that it trades back up to all-time highs, at which point, again, we'll continue to run the wheel on this Nvidia trade. And at the same time, of course, Magnificent 7 gaining a lot of liquidity, well in the $400-500 billion, getting it back into, of course, these stocks here that are driving the markets higher. So, be very careful. This is a concentrated rally in the market, no doubt about it. And the breadth is starting to fade a little bit as utilities. So again, XLK divided by XLU. Let's just come over to this chart. We saw a 3% move to the upside for this particular index. And you'll notice that, we've seen some underperformance, back-to-back months of underperformance here, but we're now starting to stabilize a little bit on the weekly time frame. You'll notice that we are essentially going sideways at the moment as opposed to straight up downs. In the past, of course, we have seen a significant decrease in technology's performance relative to utilities. You can go back a little bit further. Every single time there's been some problems over here. So for example, the dot-com bubble, this right here, some more underperformance. And right now, as much of that underperformance lasted for 3 consecutive months, we're starting to see a little bit more of a stabilization. So it's possible that we are in this kangaroo market, that we continue to rotate in and out of risk on, risk off environments, considering the uncertainty around those 2 questions, whether inflation is going to accelerate or whether we're going to see a recession or not. So that's really where we are. I think this is a market that is worth trading, because we could be in that uncertainty loop until we get some answers from the Federal Reserve, from the economy itself. So until that time, I think it is really important to be on the lookout, be very, very careful, protect your capital at all cost, and trade smartly, because the markets are trading right now. There's a lot of tradable volume at the moment as opposed to investable volume. Of course, you can find really good deals considering how many stocks are still in a correction or a bear market, but this is a market that is just rotating in and out of risk assets in anticipation of whether we get a recession or inflation acceleration again or not. So that's where we are. Hope you guys enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you are interested in joining us. So always, happy investing. I'll see you all in the next video.